Hi, I'm Clifford Bennett from Hurston Economics. We've seen a bit of a down move in equities yesterday as again people try to play this knee-jerk reaction to high oil prices, getting worried about comments about higher oil prices hurting the economy. The fact is that higher oil prices are going to hurt the US economy more than any other economy, it being the largest old world, mature Western economy in the world, where profit margins are already squeezed extremely tight. I mean, the money is to be made in Asia and Latin America, and that's why capital is flowing there. The United States is a very difficult place to maintain the profit margin because it's the mature capitalist system. So when oil prices go up, it's harder for them than anyone. So it's definitely a reason to sell the US dollar. You know I like selling the US dollar. We've got another reason to sell the US dollar. We've got quantitative easing going on. We've got, the rest of the world outperforming the US, and now we have this wonderful thing called a higher oil price. I say a wonderful thing because those who are currently complaining about the higher oil price, it's a little bit like a farmer going, I want to bump a crop this year, but I hope it doesn't rain. You just don't get strong global growth, bump a world global economic expansion without a higher oil price. It's the fuel of the economy, so of course it's going to be well bid. We continue to look for oil to go to 145. Do we think this will slow global growth? Yes. We think it will slow from 5.4 to 4.9%, 5.4% in 2011. We're forecasting 2012 it slows to 4.9 because of oil being up in the 130 to 160 range in a sustained way. It's not a bad thing, it's a symptom of global growth. Is it a threat? No. Is it a dampener? At the margin, yes. Because in Asia, Latin America, they still have huge margins to absorb higher oil prices within all of their industries, transport costs, etc. So we're looking for still very strong global growth with a higher oil price, with a higher gold price. Remember at 1310, everyone was telling you that the story was over for gold. We kept saying, no, gold's going to go 1450, 1650 this year, maybe even 1950, and we're still sticking to that. It's all part of the US dollar falling. It's all part of strong global growth being maintained. So still very bullish commodity markets. For the Australian stock market, what does this mean? Everyone looks and sees the headline Dow Jones index down a bit, and then gets worried about our local market. But our local market is more about Asia demand for our commodities. With the United States running at 2.8% last year, probably going to do better this year, 3.4% growth. Europe, very strong. Unemployment's starting to drop rather quickly in Germany. The outlook is strong for commodities globally, and our demand into Asia is going to stay there. So our market will be buoyed by the fact that demand's going to remain strong and commodity prices are going to be even higher this year than most people expected, in line with Hurston Economics forecast, higher than most people expected. But that's not priced into our resource stocks, and they're going to be going a lot higher. So this dip today, even on the day, is an opportunity to buy. The outlook is very positive. The Reserve Bank isn't going to be increasing interest rates this year. Maybe at the margin, still that risk of a 25-point hike. The rest of the world's joined the Hurston view on this. We think actually, even if they raised rates 25 points, they'd stay on 5% throughout 2012. Inflation is not an issue. By the way, in Bernanke's comments yesterday, his full comments, he mentioned that a sharp rise in commodity prices, oil prices, will not necessarily flow through to CPI. He saw it as a threat to the economy in the longer term, maybe. His key point was it won't be a lasting impact on CPI. So things are far more bullish than that Dow Jones index price says, and I say buy the dip. Have a great day.